There are 3 recession indicators that are sending a few mixed signals about the economy. Let's get into it. As you guys know, last week, the very first one, it's become very popular on Twitter. And by the way, I'm very active on Twitter. If you want to engage with me there, I'm very active. Follow me at EMPaulG. The Sahm Rule. This was created by a guy with the last name Sahm, S-A-H-M. It's a very simple rule. You take the last 12 months of unemployment. You take the low. At 0.5%, when the unemployment rate over the last 3 months on average is 0.5% higher than the 12-month low, that's supposed to be an indicator for the Fed that we're in a recession. So let's check out what the data has been as of late. This is the last 12 months of unemployment. The low was right here, excluding July. The previous 3 months was an average of about 4% on the nose, okay? The low over the last 12 months was July of last year. We were at 3.5%. Guys, we just hit 4.3. So we're above that average right now. That is the Sahm Rule. And a lot of people say that's the Fed's preferred way of looking at unemployment and how that affects recessions. And I want you to keep in mind, unemployment rate of 4.3% is still very, very low historically. Look at this chart of unemployment in the US going back to before 1950. Guys, look how low we are here. It's still so low historically. Remember, the Fed's goal is to keep unemployment between 5 and 6%. When you get below 5%, it starts to become inflationary. Why? Less people available for work. Employers have to pay more to get better quality people to come work for them. And when they pay more, how do they pass on that cost? By increasing the cost of their goods and services. That's the inflationary aspect. Also, more people out there making more money, they start spending more. It's a whole vicious cycle. Here is historical going back to 1960 on the Sahm Rule. And it's hard to see because we had these big spikes here during COVID, during the great financial crisis, during the tech bust, early 90s recession, early 80s. But right here, we just hit that point of above 0.5% difference. That's kind of their way of saying, okay, and when it happens, guys, look at all these times, gray areas are the recessions. So of course, a lot of people think, okay, have we hit a recession? But that leads us to the second, the inverted yield curve. I believe the yield curve, the 2-year versus the 10-year inverted on July 6th of 2022. And just yesterday, it finally went back into the territory of not being inverted, the regular yield curve. Now, the 2 versus 10-year. Why does an inverted yield curve indicate kind of recession? Well, guys, the longer you lend somebody money out, the higher your interest rate should be. But when it's inverted, it means the 2-year yield is higher than the 10-year. So that means you can lend to the US government at a higher interest rate over 2 years than over 10 years. So why is that negative? Well, that means that the market is saying the short term is more risky than the long term. Therefore, they see problems, recessions, issues in the short run versus the long run. That's the idea behind how the inverted yield curve is an indicator for recessions. People expect more problems in the short run than the long run. I believe this was the longest yield curve inversion, but like I said, yesterday it went right back to normal. So we still have the Sahm Rule that got triggered, but then we had the yield curve inverted for 700 and some days, a record, and it went back to normal yesterday. Question is that going to continue or is it going to reinvert back? We have no idea. That's some of the dichotomy I'm sitting there saying, going, well, this is saying this, but on the other hand, this is saying this, which leads us to our third indicator, the actual technical definition of a recession. Now, I know that depending on what political party you're in, who's in power, everyone falls back on this technical definition. But the technical economic definition of a recession is 2 consecutive quarters of negative real GDP growth. So when I say real, I mean that factors inflation in, not nominal, where you just care about the level. So let's look at the history of that one. So guys, if you look back here, the last time we had it was early 2022. We had 2 negative real GDP quarters there. So technically that was a recession. Now, I will say, these are rules that are made. And a lot of times a recession, look at China, for example. A recession in China is 4 or 5% real GDP growth. Not even negative. It's still just slower positive growth. To me, that's what I look at when I talk about recession. When we talk about recessions here, it's not just an actual technical definition of this happened, therefore this. To me, it's also a matter of saying, how do the consumers feel? How do the business owners feel? How do they look at the world? To me, we get caught up too much in recession, not recession. There are slowdowns, there are growth periods, etc. When we attach this word recession to all of these things, it becomes such a negative connotation that it becomes catastrophic for people. And the other point to make in this video, there are so many data points out there. So here we have, oh wait, there's positive real GDP growth after 2022. We're not in a recession, and you better believe whoever's in power would flaunt that beyond belief. But then we have the Sahm Rule. But the Sahm Rule is triggered because we're at 4.3% unemployment. Does that seem reasonable? But then we have the inverted yield curve, which was inverted for 700 and some days. And even I thought in some videos, you heard me say, maybe we did have a soft landing. Maybe it was the first time ever. I don't know. The point of this is, guys, nobody really knows. What matters to you is not what's going on over here. Yes, I get it. If you're going to lose your job because of recession, that sucks. I'm not trying to diminish that. No way, shape, or form. But if you're watching this video and this channel, it probably means you're pretty responsible financially. You're probably saving money and you probably care about your financial future. So any sort of temporary job loss is probably going to be exactly that for you. Temporary. And I applaud you for that because you're out here learning about money on YouTube. And by the way, if you like this channel, if you like videos about recaps of the market, what's going on in the market in the short run, earnings releases, subscribe to the channel. We have this channel. It's our second channel. It's called Everything Money 24/7, and it's dedicated to quick reactions and quick comments on what's going on today, exactly right now. We saw a lot of volatility yesterday. You saw the Nikkei index fall 10, 11, 12%. Today, it's back up 10, 11%. It's an unbelievable world out there. There's so much data overload. I'm going to throw more data at you. This is consumer sentiment. Guys, consumers make up 70% of the U.S. economy. You better believe that if there's a drop in consumer sentiment and people are fearful, what are they going to do? They're going to stop spending, or they're going to spend a lot less. And even a 5% decline in consumer sentiment would throw us in a recession very easily. Hell, even a 3% decline. But look at this. We're at consumer sentiment levels that were during recessions. In fact, boom, this was the early 80s when Reagan had to come out and say, guys, this is going to be nasty. We had high inflation here. We had 15% plus inflation. We had interest rates of 18, 20%. And we have consumer sentiment right now at those levels. So somebody on Twitter who's a futster, do you realize consumer sentiment's at the same level we were back in the early 1980s with 18%? Yeah, but we have thousands, we have millions of data points out there. The question is, what really matters? This is why when we talk about investing, we talk about dollar cost averaging into low cost ETFs that match the market. Don't worry about where the market's going to go in the short run. Worry about hitting your financial goals. And if you choose to buy individual stocks, buy great companies with great balance sheets that can build on themselves and compound for a very long time. So guys, those are 3 recession indicators that are very popularly regarded. And yet we get some mixed signals here based on when you're timing and looking at it. So guys, I don't know what to tell you besides don't worry about those things. Worry about saving more money, buying low-cost ETFs. And if you want to buy individual stocks, I love it. And do me a favor, realize that you have to buy great companies at great prices and look for these bad times as your opportunity to do so. Thank you for your time.